Hello guys, today we will discuss a couple things concerning recession because recently it gained some attention. And I mean this current negative sentiment on the market and the mainstream media that are fueling this narrative that the current economy is going toward an imminent recession. You know that reality is more complex, and because of that we will check some of the leading market indicators to answer this question, which is if the recession is really happening right now or not. So we know that, for example, stocks are reflecting what will happen in the economy because the market is the best evaluator of the economy and it is pricing what might happen from 3 to 30 months from now. So we will digest through this analysis that people from the Fed are not that stupid as many might think. In fact, I must admit that they are geniuses, and we will explain also what is a real recession. In the beginning, I need to say straight away that this rapid change in sentiment means that the continuation of the bull market is inevitable. 2023 and even 2022 in the second half of the year will end in good gains on the market. So as I was trying to say in the previous video about what will happen in 2022, you need to stay calm during those volatile moments. But okay. Let's move on with the topic. If you didn't realize that already, there is something like a leading economic indicator. It is derived from data like profit margins of the companies, bond yield curve, PMIs, and so on. By analyzing this data, it is trying to forecast or rather predict if there will be a recession in the economy or not. You might wonder why you didn't hear about it before. Well, one of the reasons is because it is very complex and it is not so popular. This graph shows you the data of a very similar to that index. I can't show you the actual index right now since I would have to log in or register to some services and so on, and I just didn't have time to do it right now. But I'm sure if you Google leading economic index, you'll find it. The way you should read the index is simple. We should be checking time frames from 3 to 6 months, and if the index during this time is flat or rising, it means that the recession is not possible to occur. As you can see right now, the value is not falling, it is rising. As for the history of this indicator, you must know that it never failed, because it was never well known, commonly used, and on top of that, its complexity was so considerable that the market wasn't able to price it correctly. Another thing is that the investors in the midst of euphoria or fear are forgetting about many key indicators, key factors, because they live in an illusion that is created by the mainstream media. And this indicator predicted the situation from March 2020, GFC in 2009, and the dot-com bubble in 2000. So you can see that the current situation is not that terrible as many of the financial gurus are saying to you. There are some negative factors like rising inflation, which is caused by the disrupted supply chains, as we talked about previously many times, or things like energy crisis. If I could compare the current situation to, for example, 2011 and the fear that the European Union will fall apart, or to 2018 and the fear against the rising interest rates and kind of a correction, then I could say that right now there is a chill mood on the market compared to those situations from the past. Of course, there are companies that have lost a lot of value, but the companies that I'm, for example, showing you many times in my videos, the most liquid, the most stable, we can say, like Apple, Google, Amazon, or even Tesla, because of their capitalization, they lost a lot less. Even if you compare the markets to, for example, the Russian index, which lost more than 20%, if we compare it to SP500 on the other hand, which lost 10% during that time, from which it's already regained half of this movement. If you compare it to, for example, Turkish market, terrible situation, or even the Japanese market that has many problems. So if you look at it this way, the situation in the US is not that bad, and the best thing you can do is to just add to the positions. To do that, you need to switch off your emotions, and I'm aware of that. That is hard, but nobody said it would be easy, right? So switching emotions is the key to making a good investment decision based on some numbers. For example, Charlie Munger, the partner of Warren Buffett, one day he said that every investor must go through a period of a 50% drawdown in order to learn from it, and to realize that the markets are not only the making money machine, but in short terms it is a machine that burns the money, because of course of the volatility. So again, answering the question at the beginning of the video, is the recession coming? No. Absolutely not. As for the Fed people that I suggested are geniuses in the beginning of the video, they are because they announced the tapering of the QE and withdrawing from any aid to the market, any direct intervention, right before a cyclical negative period, which we discussed in one of the previous videos. It concerns political cycles, i.e. midterm elections and US's political impasse. You must know that those cycles are stronger than any of the measures of any central bank on the planet. They use that moment, and now everybody will be saying that the Fed started tapering QE and now the stock market is falling. This is completely untrue, and there is no correlation between that. If we check returns on investments after the rate hike, you will notice that they are positive. The rate hike itself is not a positive factor, of course, but it doesn't influence a company's profits from 3 to 30 months. So you must remember, the leading economic index for the US economy, which is the biggest one in the world, is rising right now, and it is not possible for a recession to occur in at least next 6 months. I want to share with you another very important indicator, which is not priced in right now on the market, which most likely you know about, and this indicator is Philadelphia Fed Manufacturing Index. There was never a recession when this indicator was above zero level. Something like this never happened. Of course, this one is also not a perfect one, because it was, for example, below zero when we had a bull market. But this is another confirmation for the current situation, which isn't the worst. Yet another thing is index of high yield bonds, which in simple words can be said that these are garbage bonds, high risk bonds which pay more interest, but they are more risky. And here also you can see that right before a recession, right before significant correction, the yield on those bonds rose significantly. You can see here right before dot-com bubble, GFC and 2020. So again, you must remember that stock market always price all publicly known information from 3 to 30 months, and for us to see the situation where the recession could occur is to see minimum 20% drop from the broad market index, for example like SP500. This correlation was introduced by famous investor Ken Fisher. Well, this correlation was known far earlier, but he described it accurately and spotted those time frames. So again, if we add the political cycles to the current negative sentiment from the market, our conclusion should be that these 6 months will be negative for us. From various portfolios of hedge funds, the second presidential year is negative to a certain degree, of course, at least its first half. So you see, there is no way that the stock market could crash more than 20% and after that not come to a recession. So right now those things are excluding each other, which means that a recession is impossible, and so the retracement of more than 20% on S&P 500. As a confirmation, also right here you have the article from Reuters that wrote about the leading economic indicator a couple of weeks ago. So yeah, but apparently nobody was reading it too carefully. So at the end right now, let's jump into the platform and see the chart of S&P 500 and see what we can do at this moment. Okay guys, so right here we have the S&P 500 chart, and let's zoom in. You can see that, for example, right now we bounced off this very strong resistance level, this one over here, which you can see clearly. That's the first major thing. And second thing, here was some consolidation, some rectangle pattern, which is a reversal pattern. Another thing. So I will show you what I have on mean. I have on mean this moment over here. You can clearly see it's a form of a rectangle. So now let's delete that and let's look for possible scenarios that we can use this current situation right now. So as usual, let's measure everything with a Fibonacci retracement. So we have over here down below this notch to which we should extend our measurement, and we can clearly see that we already, from the highest point over here to the lowest point, we already recover more than 50%. We broke through the 50% retracement boundary and we stopped at 61.8. So good moments. Of course, let me quickly mark those moments. So this level over here, come on, and we are bouncing from this level over here. So the best moments that to enter the market right now is to look for example, pullback towards 50% over here and go long on the market, or wait for the breakout of 61.8 Fibo level, and after that look for moment when the price would come back and retest this level. So I had to mean that the price would break through, stopped more or less over here or even higher, and try to retest this level of 61.8 Fibo, and from that moment continuation to the upside. But you must have in mind that this first half of the year will be volatile, so you must be prepared for many scenarios. So look for things like chart patterns and some major support and resistance like we have it over here. So these are the key moments that are good for entry on the market. So if the, for example, price wouldn't do anything of that I just said, meaning if it wouldn't break through the 61.8 level, if it for example will not stop and retest only this 50 level but go even lower, so this is another key level over here, which is the upper boundary of the rectangle formation. So this will be another key level from which I would be looking for to entry on the long side. But as I said and as I explained, I wouldn't expect much more deeper pullbacks than we had over here, because fundamentals are clear right now and we have no indication for a recession to come. Therefore, the possibility of the market going below, falling more than 20% is very small. So everything comes to one conclusion, that it might happen only if we had some one-time event like we had in 2020, but nobody can predict such things. So yeah, I think that is all as for the analysis of the charts from the S&P 500, because guys, as you can see, the stock market was rising continuously and it would be hard for me to look for more technical stuff over here, because stock market is more fundamental based than technical, like we had in for example commodities or in currency pairs. So as you can see, even if we would measure with Fibo or something like that, the price levels are far from this over here, where we should look for some good moments to entry on the market. Even if we go and check, for example, over here, measure with the Fibo level, so you can see the external measurements like 127.2 are over here and 161 are over here. So right now the market made what kind of a correction? So let's do the quick math. Let's check. The level over here is 4,815, maybe 20, and we fall to 4,220 something, or 15, something like that. So we had 600 points of difference, which will make all around 12 to 13% of a correction. So as you can see, we are far from 20%. So yeah, as for the analysis of S&P 500, that is all. As always, I hope you learned something from this video. I hope you enjoyed it, and if you want more, just follow this channel and also check other social media like Instagram and TikTok, where of LiteFinance, of course, where I am posting stuff like this over there too. So yeah, thank you for watching, and I'll see you in the next one. Take care, guys. Bye bye.